Hi, and welcome to the latest monthly market update from Zurich Life. I'm Jacqueline. I'm joined today by our Head of Investment Solutions at Zurich, Ian Slattery. We're here to break down the latest market developments and what they could mean for your portfolio up until Friday, September 19th. So let's start with the big picture, Ian. August gave us plenty to talk about. There were steady returns across most of the major asset classes, and there were a lot of headline grabbing political moves. Can you talk to us a little about the main market themes in August?
Sure, thanks, Jacqueline. So, firstly, we had a bit of a disappointing US jobs report at the start of the month, which put risk assets under a little bit of pressure. But as the month progressed, we had some good earnings coming in from companies. We saw the Jackson Hole Symposium, which is the big meeting of central bankers. Fed Chair Jerome Powell started to kind of forecast a little bit of potential for rate cuts, and we've seen that in September. We'll come on to that a little bit later. But as you say, overall, a decent backdrop for the month. And indeed, if we just kind of bring up the year so far, then for both bonds and equities, where we have bonds in the blue line, in euro terms, very much recovered off those lows you saw in April and in positive territory. Bonds, a little bit more of a sideways movement in the beige line. But again, overall, multi-asset funds back in positive territory for the year so far.
Okay, looking at equities now, that brings us nicely on to the next segment. How did global stock markets perform, and what stood out from a sectoral and geographic perspective?
Yeah, so again, we'll just kind of talk us through the year so far, I suppose, across the major geographies. And again, that big narrative in 2025 has been the underperformance of the dominant US market, characterized here in the light blue line, so the one that is lagging the rest of the market. However, as we look at this, you see Japan, you see the UK, you see Europe all above the global market. And the reason they're above and the market isn't as high is that the importance of the weighting of the US market overall still slightly in negative territory year to date in euro terms. And that indeed has been a laggard on the global market. In terms of sectors, very much what we might expect when we think about the geographies. So a similar story that the tech sector globally very much aligned with the movements that we've seen in the US, and those Magnificent Seven stocks have been stronger in the last couple of months. But overall, a positive story for the last month or so for global markets. And I know we'll discuss the implications of currency movements in a little while, which has been very important in 2025.
Okay, thanks. And moving on to fixed income now and interest rates. So we saw political pressure on the Fed intensify over the previous month. Can you talk to us about what happened in that case?
Sure. So what I'm bringing up here is the main two rates that we look at as global investors. So we've got the blue is the European Central Bank deposit rate, the main interest rate in the Eurozone. And in the red is its US equivalent. So we'll tell the story of over 5 years here. You can see the big steps upwards through the inflationary environment of the back end of 21 and into 2022. And indeed, you'll notice that the ECB has started to move lower just over a year ago versus the Federal Reserve. You can see the Federal Reserve moved lower a little bit and then has held steady for quite some time. However, if you focus in on the top right hand corner, you'll see we have seen a move down by 25 basis points or 1/4%. By the Federal Reserve at its September meeting. Some people thought we may see a full 0.5% cut, but the market was broadly in line with the 25 basis points we did see. The Fed, it's grappling with two main areas it has to look at. It has to think about inflation, which has remained stubbornly high, but equally employment. And the employment market in the US, while it's not by any means giving warning signs just yet, it's a little bit more stagnant. It's not as robust as it was in the past. And in this particular case, concerns over unemployment moving higher outweighed concerns over higher inflation for the Fed, and therefore they cut. The market now expects to see a couple more interest rate cuts from the Fed over the next couple of months. And indeed, closer to home and within Europe, we may expect to see another 1/4 basis point cut over the next 6 or 9 months. Overall, that feeds into what we might expect as it does in terms of the shorter end or shorter maturity government bond indices. And they're kind of continually to move around based on the changing expectations of interest rates, such as those that I'm showing on the slide currently.
Okay, that really makes a good case for active management. Looking, you mentioned earlier that currencies, and particularly the US dollar, has had an effect on equity returns. Looking at commodities and currencies as an asset class, what were the main moves last month?
Yeah, so I'll focus in on the currency piece, and this is a chart we've used a number of times, just showing the evolution of the main euro US dollar rate in 25. As in 2025, you'll see it move from about 103 to the euro right up to 117 currently. And that upward moving chart here means that US assets aren't worth as much as we bring them back, or when we bring them back into euro terms as Irish based investors. And to bring that to life, if I just show you the chart of the US stock market in US dollar terms in the lighter blue line, and indeed the US stock market in euro terms in the line that is below. And the difference between this, it's the same asset class, it's the same underlying stocks, the same sectors, the same splits. The only difference for this huge disparity in returns is indeed the currency movement. So when we look at the large majority of global stock markets being denominated in US dollar, this has had a material impact on returns in 2025. So currency, as it always does, plays a huge role in our process as active managers. Another area we've been quite active in 2025 is our alternatives bucket, as we might describe it as, particularly in the AAA and Prisma range, where we've had a very strong material overweight towards gold. And you can see gold in euro terms, even with that US dollar weakness, has still been a stellar performer, up over 20% year to date, and almost an exact mirror image on the other side from oil, which is down just short of 23% in 2025. So whilst we talk about commodities as an asset class underneath the surface, and it's our job to continue to look under the surface at the individual holdings, a lot of volatility and disparity, particularly between these two main commodities that we look at here, which is gold and oil. So in summary, for the currency and commodities area, US dollar weakness, material effect so far in 2025. However, notwithstanding that, a very strong year for gold.
Okay, that's really interesting. I got an email yesterday that said that a sign of a good diversified portfolio will be that something is always underperforming. So I think this really illustrates that point quite well. Moving
Yeah,
on,
absolutely. Diversification is you never have all the winners, but indeed you never have all the losers.
exactly. So moving on to Zurich's current positioning, what is our outlook and how have we currently positioned our portfolio in light of everything that we've covered today?
Yeah, so just to bring us through quickly the main thoughts that we have as active investment managers currently. Look, there's always going to be potential things that can go right, things that can go wrong. So in terms of the more positive things that can impact the market, we have seen global economic growth remains relatively strong. Earnings have been quite robust at a company level. On the other hand, whilst it's not been the main topic of the market in recent weeks, the trade tariff negotiations and tensions are still looming large. And government deficits have caught the attention at the longer end of government bond maturities as well, and had an impact on yields there. So there's always things on either side of the ledger, as they say, that keeps us both positive in some cases, but very wary and conscious of risks overall. So in terms of our current positioning, we are slightly below the midpoints of equities within multi-asset ranges. Within equities, we have a preference for the Asia Pacific region over other regions, notwithstanding the dominance of the US on an absolute basis. In relation to equity sectors, as we come down through that top-down process, we're more aligned with cyclical areas, and that would include the likes of technology and industrials. Within government bonds, we have a shorter duration position, so that's to insulate us away from some of those impacts I mentioned about the concerns about government debt. And we do have a preference for corporate debt over government debt within the wider fixed income book. We've already mentioned that we maintain a material position in gold. And indeed, finally, whilst we do not have an active US dollar hedge currently, it is something that we're keeping an eye on. And that's something we can do, is to hedge or partially hedge our US dollar exposure. And we maintain that flexibility as active investment managers. So a whistle stop tour there.
I think it was very comprehensive. Thank you for going through Zurich's current positioning. It seems like we're well poised to respond to market events as they develop. So that wraps up our update for this month. Thanks, Ian, for being here with us today and for sharing Zurich's views on investment markets. We hope you found this investment update insightful and that you'll share this video and join us again next month. For more details on the Zurich fund range and download our most recent Prisma reports and our monthly investment news, visit zurich.ie.